Bringing you the latest in tax credit news, insight, and analysis, this is Tax Credit Tuesday. Sitting in today for Michael Novogradac, here's your host, Tony Grappone.
Hello, I'm Tony Grappone, and this is Tax Credit Tuesday. This is the December 2nd, 2025 episode. Welcome to the latest episode in our Renewable Energy Tax Credit Finance series. I'm usually the featured guest on this series, but today I'm stepping in as the host, and I'm thrilled to introduce our special guest, my partner, Tom Boman. In this episode, we'll cover tax issues that individuals and closely held corporations need to be aware of when considering investing in renewable energy tax credit partnerships or when they're considering buying transferable tax credits. That's right, I'm talking about the at-risk and passive activity rules. We'll discuss the rules, and then I'll ask Tom to comment on how these rules come into play in a few hypothetical scenarios to help listeners better understand how the rules apply to these types of investors. So as we like to say on this podcast, if you're ready, let's get started. Tom, please take a moment to introduce yourself and let the listeners know what services you offer with respect to today's topic.
Sure, and thanks for having me on, Tony. So I'm a partner in the St. Louis office of Novogradac. I've been with the firm for 12 years as a partner. I have 45 years of total experience. I have my law degree, and I'm a CPA. Practice primarily in the partnership arena. Some of those entities are renewable entities, and also do individual returns. And I wrote 4 articles in the Journal of Tax Credits regarding individuals investing in the solar space, renewable space. And there's just a lot of issues that individuals face in dealing with this. And I've had probably 10 to 15 individual clients that I've represented. Some of them have reached out to me after they were audited by the IRS on this issue. So I've had some experience with individuals facing an IRS exam, and we'll talk about that a bit during the course of the session today.
Perfect, thanks. And I'll just add that I have worked with you, Tom, for many years, and I haven't met many other tax professionals that are more astute when it comes to partnership tax law and how partnership tax allocations get treated by investors, whether they're individuals, closely held C corporations, or widely held C corporations. So I certainly appreciate you joining the podcast today, and I highly recommend Tom to anybody out there who is considering using tax credits and losses to offset income, taxable income, and tax liability, especially by individuals and closely held Cs. Okay, great, thanks. We have a lot to cover today, so let's dive into the questions. First off, how has the landscape changed in the last few years regarding the types of investors that you have seen in the renewable energy sector?
Yeah, the key here is that there's been more and more individuals investing in this space, and that's primarily because many of them that I've seen have had one-time significant increases in their income, and that may be from income from an IPO, sale of stock, exercising stock options, and they're looking to review their ways to mitigate their tax liability. Keep in mind that as long as the renewable investment occurs within 3 years after some significant gain occurs, the individual client can carry that credit back for up to 3 years to offset that tax. I've personally represented several individual investors, both at the origination of an investment and also after the IRS has started an audit of their individual tax return, looking at the credits and the losses.
Okay, that's great. And I'm glad you also touched on the carryback provision aspect of things. All right, but as we know, individuals and closely held corporations are subject to tax rules that can limit how individuals and closely held can use tax credits and losses from certain types of investments when compared to widely held C corporations. Can you please summarize these rules?
Sure. So individuals have to deal with complex at-risk and passive activity limits that just do not apply to large corporate investors. Because these rules do apply to individuals, it's important that individual investors review how to structure their investment, taking into consideration their personal tax profile in order to use the credits and losses and also defend their use in the event of an IRS audit.
That's great. I appreciate it. And Do you think individuals and closely held are at a higher risk of an IRS audit when compared to widely held C corporations when it comes to these types of investments?
Yeah, now a lot of the big C corps are audited every year by the IRS, but individuals and closely held C corps are rarely audited by the IRS. And for two reasons, an investment in renewables significantly increases an audit risk for individuals and closely held C corporations. And that's because there's a large tax credit involved, 30% potential credit or higher. And also the losses can be significant. And anytime an individual particularly has a very large credit or a very large loss, there's the risk of an IRS is increased significantly. And we'll talk about later where you're guaranteed to get an IRS audit as well. So
That's good to know. I appreciate those distinguishing aspects about individuals closely held versus, say, widely held C corps. All right. And we'll talk more about the tax issues that individuals and closely held face, but are there special issues listeners should be aware of when it comes to filing a return to get a large refund due to a tax credit?
yeah, and that could occur either because the credit is taken in the year the project's placed in service, or as I said before, you carry back the credit to the prior 3 years. And in any situation where an individual has a refund exceeding $2 million, it has to go through review by a special committee of Congress called the Joint Committee on Taxation. And that committee will require the IRS to audit the refund claim prior to their review. So if you think you're going to get your refund in 6 weeks, no, this process can add 2 to 4 years to the period of time that an individual investor will actually receive any refund. I have 3 individual clients right now who are all under an IRS exam because of it going through the special committee review. And for each of them, it's been more than 3 years and they still haven't gotten the refund yet. So
That's extremely interesting, and I didn't realize that. So yeah, right. With respect to particularly large refunds, or like you said, refunds exceeding $2 million for an individual, the time that can add to the process in order to receive the refund is obviously significant. All right.
I would say, Tony, though, there is a similar limit for C corporations, but it's $10 million rather than 2 million. So it's significantly higher.
Okay.
If there's a refund over 10 million for a C corp, then that also has to go through this special committee review.
Okay, so it sounds like a refund request exceeding 2 million applies to the individuals. Then we've got 10 million for, I think it's widely held. I don't know if that same limit applies to
I
closely
believe
held,
it's
please.
I believe it applies to any type of C corp. I don't think it's limited to strictly widely held C corps.
Got it. Okay. That's obviously very helpful to know. All right, now that we've set the stage, let's dig in more on the rules. First off, why are the at-risk and passive activity rules important?
Well, so the rules can significantly delay the ability of an individual investor to reduce their tax liability. Now, Congress did enact these rules in order to expand our country's clean energy bandwidth, but at the same time, these complicated at-risk and passive activity limits can significantly delay and even eliminate some of the intended tax benefits. So in order to navigate this and make sure you're going to get the benefits that you are investing in, you need to know whether you're complying with these complex rules. Otherwise, you risk losing the benefits, or at least having a significant delay in your ability to get them to offset your tax.
Right. And as we know, the timing of when you can utilize the benefits is obviously very important to investors because that helps them figure out their after-tax internal rate of return on the investment. So the timing of when they use the benefits is obviously crucial. Okay. So now that we've established why the at-risk and passive activity rules are important, let's dive into what those rules are before we talk about their applicability. All right. So let's start off. Can you please briefly explain the at-risk limits for our listeners?
So there's a separate at-risk limit for the credits and then another at-risk limit for the losses. They're under different code sections of the Internal Revenue Code. Both rules deal with how the project is financed. Generally, cash equity and recourse loans are the preferred means of financing. You generally don't have any issues with either at-risk issue for credits or losses if you strictly finance the project with recourse debt and equity. So it's non-recourse debt that has to be looked at carefully. And although non-recourse debt non-recourse debt from a lender that's in the business of lending is the preferred way of using non-recourse debt for the credits. But for the losses, there isn't any type of non-recourse debt that allows the investor to get at risk in that situation. And then for the credits, the non-recourse debt from a lender can't exceed 80% of the eligible cost basis that produces the credit. So the at-risk amount and therefore the use of the credits and losses can be lost or deferred when the project is financed with non-recourse debt.
Excellent. Okay, thank you. And what are the basic rules related to the passive activity limits?
So the passive activity limits basically separate investors' taxable income into buckets. There's 4 major buckets: portfolio income, which is generally interest, dividends, and capital gains, and business income that is active. Business income that is passive is the third category. And then I would summarize the fourth category as all other income. So business income doesn't include wages, which is somewhat counterintuitive, but it does not. And wages are in the all other or fourth bucket that I mentioned. But instead, business income is income from operating a business, and that income is passive if the owner does not manage the business, and is active if they do manage the business.
Very good. And are these passive activity rules relevant to all taxpayers or only a certain set of taxpayers?
They're relevant to individuals, trusts, estates, and closely held C corps. Now, a C corp is an entity where the corporation pays tax rather than the shareholders. Shareholders only pay tax when dividends are paid out to the corporation out of its after-tax profits. Closely held C corp is one where 5 or fewer individuals own more than 50% of the value of the corporate stock.
Okay, very good. And how do the at-risk and passive activity rules compare to individuals versus closely held corporations?
So the at-risk rules apply to both individuals and closely held C corps, whereas the passive activity limits applied also to trust estates and personal service corporations. But the rules have different purposes. The at-risk rules deal with how the project is financed, and if it's not financed to comply with the rules, then the use of losses and credits can be deferred or lost. In contrast, the passive activity limit applies after you first determine the at-risk limit and analyzes which types of income the tax benefits can offset. Now, the at-risk rules are the same for individuals and closely held C corporations, but the passive activity limit is less restrictive when applied to closely held C corps compared to individuals. And we won't go into the nuance of that, but there's a more favorable rule for closely held C corps with regard to the passive activity limits than relates to individuals.
Okay, that's great to know. Okay, so we've talked about why the at-risk and passive activity rules are important, how they apply, and to whom they apply. Now let's try and bring it all together and talk about how these rules relate to our renewable energy project.
So a renewable project is a business that sells electricity. So it's a passive business activity if the owner is not managing the business, and it's an active business activity if they are managing the business. These rules are very complex and have a lot of nuance.
Okay, great. So does it matter whether the individual investor is active or passive with respect to their renewable energy investment?
Yeah, if they're passive, then they need other sources of passive business income in order to use the credits. In fact, the ideal investor in a renewable project is one who has significant passive business income, say from mature rental real estate assets where they are not active in those projects. In that case, they do not have to manage the renewable investment in order to take advantage of the tax benefits. The problem is, I don't see a lot of those people. There aren't that many. There are investors out there that have significant passive income. Oftentimes that's a family office with mature, usually rental assets where they're not actively managing, may have significant passive income. But the ones I've seen don't have any significant passive income.
Yeah, that matches my experience as well. You know, sometimes we talk to developers who are under the impression that they may be able to find an individual investor or family office that has a lot of passive income from mature rental real estate portfolios. But then as they explore those opportunities more, they find out that there's just not that many of them out there in the marketplace.
Well, we're also seeing more individuals in the solar industry working in the solar industry wanting to do this, and they generally have zero passive income. So, and for them to take advantage of these benefits, they have to actively manage their renewable projects.
Yeah, and I kind of wonder, with respect to some of the general partners or managing members in these renewable energy partnerships, it just makes you wonder if over time, if they stay in the partnership and you get past all the depreciation benefits, I wonder if you'll start to see some individual investors in renewable energy partnerships that are getting allocated passive, positive taxable income from the renewable partnership, kind of like we've seen in the real estate space. And so I don't know, time will tell, but it just makes me wonder if someday you'll kind of have a pool of individual.
As we know, normally that doesn't happen until the outlier years after the asset's fully depreciated. But yeah, right.
We'll see, I suppose. Okay, wonderful. So, what if an individual or closely held does not have significant passive business income? Are there situations where they should consider investing in a renewable energy project?
Yes, and if they have these one-time blips in income where they want to mitigate the tax on that, then they can invest in these projects. And that's the vast majority of investors I've seen and dealt with. I haven't dealt with anybody in my 10 to 15 engagements where the individual has significant passive income. Mm-hmm. And some of those people have actually been actively participating in the renewable industry. But the rules in this area are very complex and much more complex than what would apply to simply a passive investor who has significant passive income. So once you want to be active, now you really need to focus on complying with the nuanced rules in order to be able to take advantage of the credits. Because if your refund's more than $2 million, you're going to get audited by the IRS and they're going to check you. And I had one client that had $3 million of credits, and the IRS looked at their situation and said that, and this is a renewable professional, by the way, that's all he does is renewable industry. And he was invested in 4 regarded LLCs, each one with a separate solar project. And he had no rights to manage the entities under the operating agreements. In fact, the sponsor of the projects who got them into the deal was the party that had the management rights. And so the IRS said, sorry, but you're not active. You don't qualify for these credits at all. He had the ability to potentially group his working hours with this, but he didn't make the proper election to do that. So as a result, he was passive, and it could have been structured better to minimize that risk, and unfortunately it wasn't.
Yeah, I've heard stories like that before, and Tom mentioned the 10 to 15 types of tax returns. And to listeners, that may not sound like an overwhelming number of returns, but I'm here to tell you that those returns usually involve a lot of in-depth, complex situations. And so I would say that 10 to 15 returns of the nature that Tom's talking about is actually incredible experience and perspective on these issues.
Well, you would have seen zero 10 years ago. So there's more and more individuals investing in this space, and they usually have significant amount of tax credits that they're investing in.
Okay. All right. Wonderful. Let's keep it moving. All right. So what are the major things that a potentially active investor needs to consider prior to making an investment?
Well, they have to understand what requirements they need to satisfy in order to be treated as active. That generally requires them to spend 500 hours annually in managing the project. For this purpose, IRS rules distinguish activity as an investor from activity as a manager. An investor does not make management decisions, but simply receive status reports from managers. So hours spent as an investor don't qualify to reach the 500-hour annual requirement.
Got it. Okay, very good. And is there any other helpful guidance that you might suggest?
Well, yeah, I think the form of ownership is very important. What I've seen is either sole proprietorship, which is direct ownership, and that would be reported on Schedule C of Form 1040, versus indirect ownership through a limited liability company with other investors. And if you can structure this as direct ownership in Schedule C, a lot of the issues aren't as transparent because you're not getting a Schedule K1 from a partnership. And the financing and active passive isn't just as apparent as issues. So I do encourage individual, if they can structure it as a sole proprietorship, I think that's a real plus. But most of what I've seen is ownership indirectly through a regarded limited liability company. And then if you invest in a regarded LLC as a member with other members, ideally you should be a managing member versus a non-manager. And I would discuss that with your attorney to make sure they don't have any issues with that. But if you don't have management rights, then it's hard to argue that you're active because you're not authorized to make management decisions. So that's not a good fact. So being designated as a managing member to me is a key fact. And I've seen that being used against the taxpayer, that they were not a managing member, and the IRS says, well, you can't manage it. Now, you could theoretically still group that with other activities where you are managing, as long as they're properly groupable. We're going to talk about those rules in a minute. So it's not the end all of failing to qualify as active, but it's a hurdle that you can avoid if you designate yourself as a managing member. And lastly, if you have multiple investments in different limited liability companies, the taxpayer should review and consider making a grouping election to treat them as one investment. Why would you do that? Because then you only have to satisfy 500 hours in the group rather than 500 hours in each and every investment.
And I don't have as much experience with the at-risk and passive activity rules as you do, but I can definitely relate to what you're saying, because I have had clients over the years where individuals have claimed credits and losses from renewable energy partnerships, and I've seen them go through IRS audits, and everything you're saying rings true with my experience as well. Okay, this has been very insightful, and it brings us to our hypothetical scenario portion of the podcast. And I think this will be great for listeners because it'll take a lot of the rules that we've been talking about, and we will bring them to life as we talk through kind of some real life scenarios that you may encounter. So at first, we'll talk about 3 passive activity scenarios. Okay, so for scenario 1, let's talk about individuals with W-2 income, such as a doctor or an attorney that provides services to renewable energy clients, or maybe a CEO of a non-renewable energy company. What should these types of W-2 employees be thinking about before investing in a renewable energy project?
So in the perfect world, they have significant sources of passive business income from other investments, such as rental real estate. If so, they don't have to deal with the issues of managing the projects. They don't have to be active and spend more than 500 hours a year in the projects. Those rules just don't apply to them. Unfortunately, many of the investors that I see don't qualify under this rule because they don't have significant sources of passive income. So in that situation, they better be prepared to spend at least 500 hours annually actually managing their renewable projects.
Okay, good advice. All right, now let's talk about scenario 2. In this situation, let's talk about portfolio income and whether or not a taxpayer, such as an individual or closely held corporation, can offset portfolio income as well as related tax liability with losses and tax credits allocated to them from a renewable energy partnership investment.
So I think it'd be helpful first to understand what portfolio income is for our listeners. And portfolio income is interest income or dividend income and capital gains from the sale of stock or other non-business assets. So this income is not passive business income. It falls into the bucket of portfolio income. Any investor whose main source of income is portfolio income needs to spend 500 hours annually managing their renewable investments. They have to be materially participating, is what that's called, and active in their investments, so that their renewable credits and losses are active and not passive credits and losses. If they have more than one renewable investment, they need to consider whether they should make a grouping election so that they only need to spend 500 hours annually in the group rather than 500 hours annually in each separate investment.
Excellent. Very helpful. All right. Now let's move on to scenario 3. I've heard grouping elections. You've touched on them a few times now. So I've heard grouping elections can sometimes be effective when trying to use losses and credits from a renewable energy partnership. Generally speaking, what is a grouping election and how do they work and how can they help?
So first of all, grouping only applies to individuals who are trying to qualify as active. There's no reason to group if the investor is passive. because they have significant sources of passive income to use the renewable benefits. So the IRS regulations allow an individual to group different investments. So you got LLC 1, LLC 2, LLC 3 or 4, all with different projects under them. The individual has a ownership in each one of the projects, and without a grouping election, they have to satisfy 500 hours in each entity separately. Versus grouping, they can satisfy 500 hours annually in the group. But there are criteria that the IRS provides in order to group. It's not automatic. And the criteria they look at are whether the investments are in similar trades or businesses, which is the case here, whether there's common owners in the different projects, whether they're in the same geographic location, or whether they share some common support services or have some type of interdependencies in how they operate. Now, you don't have to satisfy all of the criteria, but the more criteria you satisfy, the better. But so it's not a slam dunk. And for example, it would be more difficult for an individual investor to group a renewable business with a non-renewable business. But there's certainly arguments to group renewables with other renewables as long as you generally satisfy these requirements. And to emphasize, the individual wants to always group, if they can, separate investments, as long as they satisfy the IRS guidance, because otherwise they have to spend 500 hours annually in each separate investment, which at some point, based on the number of investments you have, is impossible because there's only so many hours in the year. It's also important to note that there's a separate grouping election related to rental real estate, and it's extremely important the investor not make that grouping election for the renewable energy investments, because that's the wrong election to make. That's the wrong grouping election. And if the wrong grouping election is made, the IRS will deny the ability to group the renewable investments, and the result is you're going to have to satisfy 500 hours in every single investment you make rather than as the group.
Words of wisdom, indeed. Okay, I appreciate you walking us through the passive activity scenarios. Now let's turn our attention to some at-risk scenarios. At-risk scenario 1. Earlier, you mentioned that there are 2 sets of at-risk rules. One set of at-risk rules for tax credits and a separate set of at-risk rules for losses. Let's first look at the at-risk rules for tax credits. How should a taxpayer think about what can be included in their at-risk amount for credits? Now, to help illustrate this, let's assume a fact pattern. And the facts are, let's talk about a partnership where Carmen is a 50-50 partner in a 2-partner partnership. The partnership owns and operates a solar facility which costs $2 million to build. The $2 million of construction costs were financed in part with a $1.2 million non-recourse loan obtained from a bank, plus $800,000 of cash equity, $400,000 of which was contributed by each partner. The partnership qualifies for a $600,000 tax credit, of which $300,000 was allocated to Carmen, and her share of the ITC basis reduction is $150,000. Again, the facility cost $2 million to build, and it was paid for with a $1.2 million non-recourse loan and $800,000 of equity, 50% of which came from Carmen. The partnership generated $600,000 of tax credits, 50% of which was allocated to Carmen, and her share of the ITC basis reduction is $150,000. Tom, does Carmen have an at-risk issue with respect to the credits allocated to her?
So probably not. What you look at in this situation is, how is it financed, and is it good financing or bad financing? And good financing is recourse debt. I'm assuming here the debt is not recourse, and good financing is equity. But non-recourse debt from a lender in the business of lending is also good financing for the credit, not for the losses, but for the credit, as long as that debt doesn't exceed 80% of the credit base. So assuming that's the facts here, that the loan is from a lender, it clearly doesn't exceed 80% of the credit base. So in this case, the financing is good. Her at-risk amount for the credit is 100%, and there are no reductions in the eligible basis for the credit.
Excellent. Okay, great. All right. Great. So now in scenario 2, we'll keep the facts the same, but we'll note that in year 1 of operations, the partnership generated a total tax loss of $1 million, of which $500,000 was allocated to Carmen. Again, the partnership's total year 1 tax loss was $1 million and $500,000 was allocated to Carmen. Now let's take a look at Carmen's at-risk basis for calculation for loss purposes.
Okay, so again, assuming the debt is non-recourse,
That's correct. Yep.
a loan that's non-recourse in the non-real estate arena does not give at risk. The only time debt gives at risk that's a non-recourse loan is a mortgage on real estate, and this is not a mortgage on real estate. So she does not get at risk for the losses for any of the debt. So she gets at risk for the cash she put in, which makes sense for 400,000. But you do have to reduce that by the 50% of the credit amount, which is a separate basis reduction. So her at risk amount for the losses is only $250,000.
Okay, great. So her at-risk basis is 250,000. That's the 400,000 she put in minus the $150,000 ITC basis reduction. Her at-risk basis for losses is 250,000. She was allocated 500,000, so she wouldn't be able to deduct the losses in excess of her at-risk basis, and that portion of losses, I assume, would have to get carried forward.
They'd be carried forward until she has more at risk. And the only way you change that is to have the debt be recourse.
Right.
Which obviously, a lot of investors hesitate to have recourse debt.
And I assume one way to be recourse is if she guaranteed the loan.
She could guarantee the debt. Some guarantees don't look real strong, but there's always a risk that theirs can challenge a guarantee. But if the guarantee is legit, you're the payer of last resort, then it should be good, and that should be good recourse debt.
Excellent. Okay, great. So now we're down to our last scenario. This is scenario 3. We'll keep the facts the same, except this time, let's imagine that the managing member, in this case Carmen, was the borrower on the loan as opposed to the renewable energy partnership. In other words, I'm talking about a back leverage loan situation as opposed to the partnership being the borrower. Is the analysis the same or different? And if so, how?
It's actually the same for both at-risk rules, both the credit at risk and the loss at risk, because the rules say you have to do the analysis not at the entity level, but at the owner level. However, if Carmen is somehow liable for the loan, such as providing a guarantee, then her at-risk amount for the losses would include the amount she has guaranteed, and she could deduct more loss.
Wonderful. All right. Thank you very much, Tom. All right. For our audience members who have specific follow-up questions, I'd encourage you to reach out to Tom directly. You can email him at tom.boman@novoco.com, and I'll include his contact information in today's notes. I'd also encourage you to check out the rest of our renewable energy tax credit finance series at novoco.com/podcast or via Apple Podcasts, Spotify, and YouTube. On YouTube, we have a dedicated playlist for our renewable energy series episodes, which makes them easy to binge watch. And if there are other platforms where you think we should be, please let us know. And if you have ideas or suggestions for future episodes, please email us at CPAs, that's CPAS @novoco.com. All right. Now let's turn our attention to what we call our off mic section. This is the fun segment where we can acknowledge our industry colleagues with shout outs. And so, Tom, please, who is your industry shout out this week?
I would shout out to Reza Karim, who's a principal with Novogradac in our New York office, who's on my team. And Reza has significant experience in the renewable industry regarding property taxes and sales tax. And on the property tax side, he can help provide projections, particularly on what the property taxes may be in a forecast, or determine whether there's any exemptions or reductions in the property tax calculation. And since property taxes are often a major source of cash flow for a renewable project, those services can be very helpful. The other thing you can do is analyze sales tax on equipment purchases, whether there's any exemptions, at what level they're taxed, if at all, and also on the revenue side, whether there's exemptions or reductions in sales tax for the revenue that's generated by the project.
Great shout out. And I'd echo your shout out. I'm a big fan of Reza. I've had him on the podcast before where we talked about state and local tax issues, taxation of tax credit transfer proceeds at the state level, and then a whole host of other types of state and local tax issues. He's great. You and your whole entire team are excellent to work with. And so thank you. Thanks, Tom. And to our listeners, I'm Tony Grappone, and thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.